Welcome back to Dividend Stockpile. Today we have a returning guest, VistaShares CEO Adam Patti, to discuss their hot off the press brand new ETF QUSA, the VistaShares Target 15 USA Quality Income ETF. The last time we met with Adam, they had just launched their other ETF, OMAH, the VistaShares Target 15 Berkshire Select Income ETF. But now they've expanded their Target 15 Options Income ETFs with this brand new fund, QUSA. So today we're going to talk about all the details of that fund, including the investment objectives, holdings, option strategy, and most importantly, what we should expect on the dividend. So with all that, welcome back, Adam. How are you?
Yeah, I'm great. Thank you very much for having me back.
Absolutely. So excited to have you back on the channel, talking about your brand new fund. I mean, just looking at how OMAH has been doing over the last couple of weeks since we talked, it's absolutely amazing the response you've gotten. And you guys have had your first distribution and things are really going well over there. So congratulations. You want to talk just a minute about Omaha?
Sure. Well, thank you. I'm humbled and extremely appreciative to the investors that have embraced Omaha. It's incredible the traction we've gotten, and it's a great product and it fills a niche, which is at the end of the day the most important, and it's a high quality strategy. So, but thank you to all your listeners. I'm sure many of them are the ones that have made us successful to this point. So Omaha is, invest like Warren Buffett, but with 15% target income annually paid monthly. Maybe it's a very simple story. So, we're buying, we have 21 holdings in that portfolio, equity holdings. The first holding is always BRKB. Mm-hmm. And then we have the 20 largest publicly traded holdings of Berkshire Hathaway as our next 20 holdings, more or less in the right proportion to what Berkshire Hathaway owns. There are restrictions around what they call RIC requirements in an ETF, where you have to, have diversification rules and things like that. But generally, the correct proportions, and we rebalance that portfolio quarterly. Mm-hmm. To bring those, everything back in line. And of course, if there's any portfolio changes, which of course Berkshire Hathaway doesn't make them very often, but who knows, maybe now with the new CEO, over the next few years, they will. So that's a quarterly rebalance. And then we run an active options overlay, and that's a daily process to generate that income. So again, it's 15% annual target per year. We pay it monthly. So we're targeting 1.25% income distributed monthly. We're not looking to beat that number. We're not looking to come below that number. So we're not looking to blow it out and all of a sudden come out with 5%. That's not what we do. It's consistent 1.25% per month.
Yeah, and I think that's why it's done so well and has such positive response from the investment community, because you do have obviously very top quality names in it. You're following what Berkshire did. And of course, Warren Buffett and his team are some of the best investors in the world. And you get that income, which you wouldn't get if you just held those individual securities. So it totally makes sense. So let's go and dive into the new fund, QUSA. So last time you were on the channel, you talked about how you're going to be releasing a series of factor ETFs. And it seems like QUSA is the first of that group. So can you give us a high level detail over the fund and what you're looking to accomplish? And then we'll dig into the details later.
Sure. So, look, the market has been largely momentum driven over the last few years. The switch is flipped clearly. Now we're in a value and quality tilted market in terms of factor exposures that would hopefully be driving excess returns over the next, 12, 24, 36 months. And of course, Berkshire Hathaway is known to be a value tilted strategy. So we've got Omaha for that. And now, so what QUSA is very simply, it's a quality tilted equity strategy. We use a very traditional, what's called a factor model. It's a fancy word for using financial metrics to identify what would be a quality security. There's 27 securities in the portfolio currently. That could go up. We can go up to 50. But right now it's a nice, more concentrated portfolio at 27. And we're using the exact same income overlay as Omaha. So the 15% annual target paid monthly at 1.25% is our target. Same team, same personalities running the strategy, same strategy.
Absolutely. So if you like Omaha, this is definitely going to appeal to you. So the three factors I saw based on your website and prospectus is you look for a high return on equity, low debt to equity ratios, and low earnings variability. So, I mean, those three factors, just on the surface, that you're going to have top quality names in this portfolio. So I think that's going to appeal to a lot of people.
Correct. So, I mean, just to broaden that a little bit and even simplify it even more, it's like, we're looking for highly profitable companies to your point. We use ROE for that, return on equity, return on assets, and we also look at EBITDA margins. So that's kind of there's three factors and there's three metrics within each factor. So in earnings variability, what we want there is stable earnings growth, right? We don't want companies that are losing money, making money. We want nice, stable earners. So we're looking at earnings per share growth in the current year, and then we're looking at it over the last 5 years as well to see the trends. On the leverage side, we want companies with low debt. I mean, of course, like as you mentioned, so we're looking at the book value of the leverage or the debt that they have on the books. And then we're looking at the market value of that debt as well, compared to their market cap. And then we're looking at debt to total assets. So we're looking at all these things to identify companies, to your point, that are, high quality, growthy companies over time. And the portfolio is very unique. It's very different than OMAH, a completely different portfolio.
Yeah. So speaking of portfolio, let's go and talk about the top 10. I mean, just looking at these, it just spells quality. I mean, you have Arthur Gallagher, which is a insurance company, Procter & Gamble, Cintas, CME Group, Visa, ADP, Microsoft, Costco. I mean, you can't go wrong with those names. And that just shows that it is a focus on top quality. Especially this year, I've been focusing on quality in my portfolio. And I think all but one of these are on my list of top quality names that I'd be interested in investing in. That's so good. It looks like you guys are like in a perfect niche looking for that quality. So, I mean, you can't go wrong with those names at all.
Yeah, I think so. So we're trying to position it just like OMAH. So, QUSA is a core equity holding. You'll have your S&P exposure, you'll have your EFA exposure, you'll have your Qs most likely. But, to get a little more uniqueness into the core equity, you want to tilt your portfolio to what factors are driving growth or driving returns. So this is a way to do that, similar to OMAH. And of course, for income investors, we view this as a core holding as well, for sure.
Yeah, I was looking at the breakdown of the sectors, and I was actually pleasantly surprised to see that as of right now, information technology is actually not the largest sector. A lot of the S&P 500, the NASDAQ, other growth and oriented funds are very heavy weighted on information technology, the Mag 7 and things like this. But in your case, industrials and financials are actually larger than information technology at this time. Is there any set guidelines on sector allocation, or is it just finding the best company wherever they fit?
Exactly. We're just finding the best companies wherever they fit, because of course it changes, right? So, 5 years from now, information technology might be a bigger proportion but to your point, that's what concerns me. If you look at investor portfolios right now, and you just nailed it as usual, the S&P it used to be that the Qs was the tech heavy NASDAQ, they would call it, right? Now everything's tech heavy. I mean, the S&P is basically a tech fund. And many investors probably don't really know that, and because they're buying the market, and the market, because of that market cap weighted methodology, if tech gets hit, which it has, and it was earlier this year, and it could happen again, I think investors are going to be very surprised. So we're trying to introduce products that will provide a little ballast to the portfolios, particularly in rough markets, that will still, participate to the upside. But when the markets get rocky, you've got these different type of exposures that will, help you long term.
Absolutely. No, it definitely makes sense. It'll be very interesting to see as you build out the portfolio, how it ends up being. You said there's about 20 or so positions right now, and you're looking to get up to 50.
Well, we're not looking to get to 50. We have the ability to do that. Okay. So 27 is the current portfolio, and that'll probably remain like that for a while. Okay. I mean, as the asset base grows, then we'll probably add additional holdings. But that's down the road. But we have the ability in the prospectus to go to 50. That's why I mentioned it. There's no plans necessarily to get to 50.
Okay, good to know. Some other key info about the fund. Obviously, it just started yesterday, May 6th. It's a monthly payer for the distribution. Has an expense ratio just under 1%. And it looks like it's about $2 million, a little under $2 million in assets as of today, which is amazing. This is your second day and you already had that much. So congratulations on that.
Thank you. Yeah, it's still a baby, but it's gotten off to a crazy start. I mean, I'm really, again, it's about the community, that listens to your show, and that is really driving this. They've really embraced us as a company, which I'm humbled and appreciative. yesterday was our first day trading. We did over 14,000 shares in the first day, which Omaha did 1,400 in its first day. So, I'm really excited to see how this grows. And, thank you.
Yeah, I think the numbers say it all. If the fund is growing, especially at a quick base, people are talking about it on Twitter and other places like that, you've hit the right spot. So I think it's only going to go up from here. So obviously we talked about your holdings. We talked about how that works. Let's move over to how you do the income generation. And so based on your last discussion, and obviously my understanding, you're writing cover calls on some, if not all, of the holdings in the portfolio.
Yes.
Do you guys have a set delta or amount out of the money you're looking to write on each of the holdings, or how do you approach it?
Yeah, so this is a fully data-driven process. These are not cowboys and cowgirls running this strategy, waking up in the morning and saying, let's trade some calls, and not that you were implying that, but I'm just saying it's important that investors understand everything we do is institutional quality. My whole background is institutional quality, which sounds boring, but I think it's, it's important when you're in the investment business to provide quality. So we use a data-driven process, and we're selling out of the money calls, but we're also selling call spreads. And I want to mention that because you're very knowledgeable on the options game, more so than myself. I don't run our option strategy, but I can talk about it. So our call spreads are important, particularly in more volatile markets, particularly if the market's low and it's going to shoot up. We want to retain that ability to capitalize on the upside, and which is important. So we're selling out of the money. We're trying to hit that 1.25%. That is it. So we'll calculate the how far out we're going, and where we're executing these trades, how far out of the money based on that 125. Yeah. So and that's it. It's out of the money by 125. That's where we're executing it. Whether it's a week out, 2 weeks out, 3 weeks out, 4 weeks out, we're going to hold that. Mm-hmm. And the minute we hit that 125, we're scraping that income. We're out of that position. So we're not holding it to try to earn a little bit more. We don't want to get our securities called away. Now, of course, I can't guarantee that never happens. There could be investors out there that don't really understand options and, call them away at the wrong price. But, largely it's an efficient market. So, once we hit that 125, we're out of that position and we're rolling into the next position.
Yeah, that certainly makes sense. You're going to, hit your targets and not try and shoot for the moon when it comes to distributions. You want to be able to get the upside in the underlying holding as well. I was looking at the current holdings, and I'll pop it up on the screen later. But just as an example, you have calls on Microsoft right now at about a $4.50 strike price for about 2 weeks out. Right now, Microsoft's trading at $4.33. So there's about a $17 upside before the call would be in any kind of risk of getting the shares taken away. So that's about 4% out of the money as of when I looked at those. So that's pretty good for a 2 week period, 1.5 week period. But in most times the market wouldn't go up 4% in a week and a half. So I think it's pretty conservative approach, but it still gets you the money you want. And it looks like you do similar calls on all the other holdings to generate that 1.25. There were some other ones I saw, they were like 14 or 15% out of the money. It just all depends on the volatility of the market and that particular holding.
That's correct. And the volatility, plays to our advantage in some, so we are going to, go a little bit more out of the money there. And look, and at the end of the day, if we're scraping that 1.25% and we get out, and if we, excuse me, if we're able to enroll and do it again, and we're making more than we thought for the month, we're only going to pay that 1.25 out, and we'll roll the rest of the profits, if any, back into the NAV.
Yeah, and that's great because a lot of people are concerned, especially with these high income derivative products, if the NAV is going to be able to sustain itself and grow over time. And hopefully, based on that limitation you set on yourself, that you're only shooting for that 1.25, then the rest can be, appreciation, which is what most people need.
And also, I mentioned dividends are paid on many of these securities. Yeah. So that's our income generation is exclusive of the dividends. So if there are dividends paid, that's rolled back into the NAV as well. So again, it's all about not having that NAV erosion. At 15%, we're not going to be subject to that very much anyway. But I also do want to mention that this is an important point. There's no free lunch, right? So we are not going to keep up necessarily with the market if the market goes straight up, even with the call spread strategy. So, we're looking at, probably, 75% of the upside and kind of, 85, 90% of the downside. So I just want to make that clear from a total return perspective. So, investors should know that so they're not surprised.
Yeah, there's always a trade-off. I mean, you're writing a covered call, you're getting the income now and by capping yourself on the amount of gains you can get, and that's the trade-off. So if the market is flat or slightly up or slightly down, you'll probably perform really well. But to your point, if we have a 9% day, on over and over like we've had the last couple of weeks, you're not going to keep up with the overall S&P 500 because of the limitations of the cover calls. Correct. But I think most people who invest for income, especially through derivative products like cover calls, understand that trade-off.
Good. Yes.
Awesome. Okay, so let's just do a quick summary. So this QUSA is a monthly payer, 15% annualized income target, plus hopefully capital appreciation. You're focused on 3 overlying factors: high return on equity and profitability, low debt to equity, and low earnings volatility. So you want stable, growing, strong companies in this portfolio. On top of that, you're going to do your options writing to gain that current income. So who or where does this particular holding fall into someone's portfolio in your mind?
I would use it as a core equity exposure. So, particularly what we talked about the over concentration in some of the big tech names in the major indices, which I view as a risk. I mean, others may say, well, I like that, but I personally view as a risk. I would use this, similar to OMAH, as a core equity exposure. Not 90% of your portfolio. You want to have a well-diversified portfolio. And of course, I'm speaking to people who know that, but I always like to mention that. So, for a portion of your equity exposure, you want to use this product to tilt your exposure to quality companies that will hopefully give you that ballast in your portfolio, yet retain the upside capital appreciation while getting that 15% income target per year. And for those income investors, certainly, again, core holding for sure. They're very unique holdings. I'm guaranteeing that I shouldn't guarantee anything. I'm not guaranteeing. Sorry. But I'm sure that most investors don't own a lot of these companies, or, the P&Gs, the Microsoft, of course, but, the CMEs and the Cintas and things like that, they're very widely held, but many income investors don't have access or exposure to those.
Yeah, and that certainly makes a lot of sense because they're not the household names that you think about when you're thinking about investing. So, but I mean, they're all very strong companies. I've researched every single one of them on your top 10. So I understand the quality that you guys are going for, and having it actively managed, having a team of investment professionals doing the research, doing the digging to understand all the ins and outs of these companies, and if they are sustainable and if they are quality, is something that we don't have to do personally. So you get that benefit as well. So overall, I really love it. I think the community is going to love it as well. Best of luck with the growth of the fund. And I'm sure we'll be able to talk soon about your next offering when it comes out.
Absolutely. I really appreciate you having me on. And thanks to your audience for the support.
Absolutely, Adam. Okay, so it's QUSA, the VistaShares Target 15 USA Quality Income ETF from VistaShares. Thank you so much, Adam. We'll talk to you soon.
Thank you. Take care.
Yeah, you too.